We're going to get started. Good afternoon. I'm Femi Cadmus, Director of the Goodson Law Library. And on behalf of the Office of the Dean and the Goodson Law Library, I'm pleased to welcome you to our second Faculty Author Celebration of the year. Today, we have the distinct pleasure of featuring Figuring Out the Tax, Congress, Treasury, and the Design of the Early Modern Income Tax by our very own Professor Larry Zelenak, Pamela B. Gann Professor of Law. Now, in case you're wondering what there is to celebrate about a tax book, I am going to point you to a review that resonates very strongly from Alex Raskolnikov, Wilbur H. Friedman Professor of Tax Law at Columbia Law School. I'm going to read his review. Who would have thought that a tax book can be so much fun? Part tax history, part a comedy of errors. Zelenak's story about the emergence and development of the American tax system is a joy to read. It holds lessons for policymakers, offers ideas to academics, and helps taxpayers to form an informed opinion of what a good tax system should look like. Now, if that's not a wonderful review, I don't know what else could compare with that. I like to look at places that books go, and books tend to go different places, places that you and I will never go to. We can dream, we can only dream. Now, this book, this wonderful book here, has been to over 165 places, 165 libraries all over the world. It's been to Durham University Library, and that's not Durham here, that's Durham, the United Kingdom. It's been to Malaysia, Berlin, the Netherlands, Taiwan, Pretoria, South Africa, just to name a few. So this is an excellent book. Before we begin, I'd like to give thanks to those who have made this event possible, and that includes staff from the Law Library, Sue Hicks and Jennifer Behrens, the media services who are recording this event, and events office staff. At this point, I'll now turn things over to Professor Rich Schmalbeck.
Thanks, Femi. Let me begin with a conclusion, I guess. This is really a fine book. And despite the sexy title and racy cover art, it's really a very serious book as well. It contains a great deal of historical detail that is not or was not until the book came out very well known by the tax bar or tax academics. I guess this stuff was available to be known, but it remained for Larry to dig it out, and the field owes Larry a great debt for his work on that. Larry's interest in tax history began in the early years of the George W. Bush administration. And I wondered at the time, was this a leading indicator of the decline of the income tax? Or maybe it was just a safety play on the theory that the income tax would always have a past, even if it had a very limited future. But if we were worried, Larry and I, we really needn't have been. The income tax has proved very hardy. It's survived now multiple sessions of Congress this century, including the most recent one, when sworn enemies of the income tax controlled both houses of Congress and the House at 1600. But the income tax has endured. Still, Larry remains mired in the past. But to good end. To good end. These stories are fascinating in their own right, but also illuminating of some of the basic principles about tax reform. In reading it, I thought of a question Stuart Benjamin posed to me not too long ago. He asked me, what's the low-hanging fruit when it comes to tax reform? And I didn't give a very good answer because, unlike Stuart, I was trying to concentrate on the basketball game we were both attending at the time. But several items on any tax reformer's list would be among the topics that Larry focuses on intensely in the first half or so of this book, such as the rule that allows taxpayers to take a charitable deduction for the full value of contributions of appreciated property, clearly a bad rule. The rule that gives heirs a basis in property that they inherit that's equal to the fair market value of the property at the decedent's death, thus making all the gain that accrued during the decedent's life simply disappear, and several others. But you have to ask, what does one mean by low-hanging fruit in this context? It might mean obvious errors that are subject to relatively technically clean and easy solutions. And that seems right, but one immediately notices that much of the low-hanging fruit in the tax area has been hanging there for a long time. It's overripe to the point of rottenness, but still it hangs. So if low-hanging fruit means fruit that's easily plucked from the tree, then these tax anomalies are up in the highest branches. There are a lot of fruit and tree metaphors, by the way, in tax, but I think I've squeezed all the juice I can get out of this one. One of the major points, though, is that there's a reason that tax design errors are hard to correct. Once they exist, taxpayers invest in them. And that provides durability for two reasons. First, having invested, those taxpayers will resist the reforms. But second, and a little more subtly, in some ways they have justice on their side. And as an example, I'd cite the 2003 change that Congress made when it reversed a 90-year-old rule that dividends were to be taxed like ordinary income. Since that time, most dividends have been taxed at the lower capital gains rates. Stock values, which at the time were still suffering from the tech bust, went up in response, and with a pause during the financial crisis of 07, 09, they've continued going up. We could restore the dividends our ordinary income rule, and perhaps we should, but what would happen? Dividend-paying stocks would immediately lose 19.1% of their value. That may sound, by the way, like a figure I just made up, but actually it's a series of careful calculations based on assumptions that I just made up. Altogether different thing. So anyway, they'd lose 19.1% of their value, and who would be the losers? After 16 years, most stock is held by people who didn't benefit from the 2003 change, but bought at prices that reflected that change. And if you reverse it now, they are the ones who would suffer the most. So reform, even of egregiously bad rules, is difficult, yet sometimes it happens. And Larry offers a convincing explanation of why it sometimes does. I won't spoil the story. I'll leave that to him if he chooses to spoil it himself, but it's in chapter 11. But you'll appreciate it more, and it will be more convincing if you read chapters 1 through 10 first. So in sum, Larry is doing in this book the two things that are present in most high-value historical studies. First, there's a strong narrative line with lots of wonderful detail and interesting stories. But there's a strong analytical thread as well, drawing lessons that have broad implications for the future path of tax reform. And I'm going to dispense with the conventional biographical introduction because I think everybody knows Larry, and I'll just turn it over to him at this point for whatever he chooses to say in his defense.
Thank you, Rich. You were funnier than I am going to be, and I don't like that. But, so the current income tax that's been with us ever since 1913 was actually the Congress's third try at a federal income tax. There was the Union had a federal income tax during the Civil War, but that was allowed to lapse in 1872. Then there was a federal income tax successfully gotten through Congress by the Progressive Movement in 1894, only to have that declared unconstitutional by the Supreme Court in the Pollock case the next year. Finally, in 1913, Congress enacted a federal income tax that stuck, and it's been with us for better and worse ever since. So what this book offers is a series of sort of case studies in how in the early years of the modern income tax, the 1913 income tax, Congress and the Treasury, and I say sort of quite consciously Congress and the Treasury and don't include the courts, because in these stories the courts play only a very minor role. How Congress and the Treasury gradually sort of figured out, or in some cases failed to figure out, some important design issues concerning the tax. So what I'd like to do today is save some time for questions, but tell you basically as many stories as it turns out I have time for. And since these are all kind of discrete stories, I can just, I can just stop when we're out of time, and you'll still have some relatively complete stories. So although great historical forces were at work in the creation of the 1913 income tax, to an almost shocking extent, the actual drafting of the income tax was the work of one man. There he is, Cordell Hull, who might fairly be described as the Thomas Jefferson of the of the federal income tax. Well, first of all, I got to tell you a little story. I am sad to report that the book tour for this book has been rather abbreviated, shockingly enough. But I did talk about the book a few weeks ago at Samford University, Cumberland School of Law in Birmingham, Alabama, which, the reason they were interested in this topic is Cordell Hull is by I think a wide margin, the most famous alum of Cumberland Law School. And this was part of the so-called Cordell Hull lecture series, which I found out, even though the lecture series has been going on for years, my talk was the first one that was actually about Cordell Hull rather than merely in honor of Cordell Hull. It was given in the moot courtroom, and there was a lovely oil painting of an older Cordell Hull hanging over the chief judge's bench, very prominent in the room. And in order to show this picture, we had to put down the screen that blocked the that blocked the oil painting. The good news is there is no oil painting of Cordell Hull behind the screen. Okay. So if you've, how many people have heard of him at all? Okay. So if you have heard of him, it's probably mostly because he was the longest serving Secretary of State in U.S. history. He was FDR's Secretary of State. And in 1945, he won the Nobel Peace Prize for his work founding the United Nations. 1945 being a pretty good year to win the Nobel Peace Prize. Right? Some people have heard of him for that reason. I think in his role as the author of the income tax, he's less well known, but he has a pretty good claim to being the father of both the United Nations and the federal income tax, which obviously would make him more popular in some circles than in others. But in any event, it's kind of a big deal, I would think. He wrote his memoirs, and there was sort of a hagiographic, non-scholarly biography written of him by a friend while he was still alive. But there is no modern scholarly biography of him. If anyone's looking for a project, I would commend that to you. But anyway, so it's 1913. Democrats who have been pro-income tax for some years are now in control of the House, the Senate, and the White House, President Wilson in the White House. And they all supported a low-rate, high-exemption federal income tax, not so much to raise revenue as to help offset the regressivity of the tariffs. And in February of 1913, the last three states needed to ratify the 16th Amendment to overrule the 1895 Pollock decision, ratified the 16th Amendment, so there was no longer a constitutional objection to an income tax. And it was clear there was going to be an income tax. But who was actually going to draft it? The House and the Senate did not have the kind of legislative drafting services, staffs they have now. They didn't really have anything. But a young lawyer and a graduate of the one-year course of law at Cumberland University, which was then in Tennessee, by the name of Cordell Hall, who was a member of the House Ways and Means Committee, raised his hand and said, I'll write it, and nobody else did, so he got the job. His political mentor had been a former member of Congress from Tennessee by the name of Benton McMillan. McMillan had drafted a lot of the 1894 income tax as a Ways and Means member, and McMillan had converted Hall to the cause, to the point that when Hall arrived in Congress in 1907, he had, according to his memoirs, he says in his memoirs, he had studied the topic of income taxation obsessively for almost 15 years by that point. He kept right on studying it after he was in Congress. His view was that the income tax was, quote, the best, the fairest, the most equitable system of taxation that has yet been devised. He was so persistent that he says in his memoirs that that even supporters of an income tax, when they were walking down the halls of the Capitol and they saw Hall coming in the other direction, would turn and walk away because they were tired of getting buttonholed by him about the income tax. When he drafted the tax, he relied on what was available to him, which was the income tax of the United Kingdom, which had been around for almost about 100 years by that point, and some other jurisdictions. There was actually a modern, the only modern income tax at the time in the United States was the Wisconsin income tax, which had been enacted 2 years earlier. And especially he relied on a 600-plus page treatise published in 1911 by Columbia University economist Edwin R.A. Seligmann on every... the title should have been Everything You'd Ever Want to Know About an Income Tax. And Seligmann covered the history of the income tax in both the United States and about every other jurisdiction you could possibly care about, and made all sorts of recommendations for what a federal income tax should look like. And to a large extent, Hall followed those directions. With the benefit of, so how good a job did he do? Well, with the benefit of more than a century's worth of hindsight, one can certainly find things to criticize. A leading example is Hall's puzzling failure to have any fixed opinion on the capital gains question. So there were several days of debate on the House floor on the income tax, with Hall being in charge of answering questions about the tax. And he repeatedly got questions, well, would this tax include a tax on capital gains or not? Part of the reason that was a question is the UK tax did not tax capital gains. And I swear I'm not making this up. Every time he was asked the question, he gave a fundamentally different answer. You know? The statute itself said nothing one way or the other, and it's clear that he hadn't thought about it, you know. And you know, that seems like an important enough question that you can't quite give him a grade of 100 on, for having failed even to have considered that question. So it's easy for me to point out flaws, but from another perspective, he did well enough that when just 4 years later, the new federal income tax was pressed into service as a major source of funding for the United States participation in World War I, it proved up to the task, and the top rate, which had been 7% in the original income tax of 1913, was increased to 77%, and it worked well enough that the war effort was financed. It also worked well enough a generation later when converted to a mass tax in World War II to finance World War II. And as Rich said, although it's you didn't use the following term, but it's been kind of a fabulous invalid for pretty much its entire existence. Over 100 years and counting, it's still the most important federal revenue source today. So, and he's largely responsible for that. As you might imagine, Hall endured quite a bit of criticism for his championing of the income tax. There was a 1913 story in the Los Angeles Times, the feature story about Hall, which described him as the author of the income tax and, not coincidentally, one of the most unpopular legislators in America. On the other hand, the same story described him, and you can be the judge here, but as tall, wide-shouldered, and lean, with noticeably fine eyes and thick hair, and as, in short, a very good-looking man. So he may have been vilified for some, but there was that. He saved the correspondence he received in 1913 about the income tax. It's now in the National Archives. Some of it was complimentary, and most was at least polite enough. But then there was a letter from I don't know who this person was, Mr. Louis Jackson of Upper Montclair, New Jersey, which this reference will be lost on most of you. It sounds like someone who would have written to Rosanna but Jackson had read a newspaper story criticizing some infelicitous drafting in the act, and there certainly was some, and maybe I'll get to that later. And he wrote to Hall, "I plainly infer that you must have pushed yourself forward to write something or to undertake something which should have been done by a more competent person." Well, he saved the letter. In his memoirs, Hall ends his account of his labors on the 1913 income tax by quoting a July 1914 letter he received from Treasury Secretary William McAdoo, congratulating Hall on the early success of the administration of the tax. McAdoo wrote, "The law is new, and although unpopular in some circles, it is not 1/10 so unpopular as the average man expected it to be." Well, you know what? It's not the very highest praise, I think, to be told that the fruit of your efforts, although unpopular, not as unpopular as we expected. But what's interesting about the way he quotes this in his memoir is he gives no indication at all that he saw that as any kind of backhanded compliment. He just says this. I was so happy to get this letter because it was such a nice compliment. Well, he seems to have understood that something along those lines was the highest praise that the author of the income tax could really expect. Okay. So let me give you a whirlwind tour of sort of selected topics here. There's a chapter on withholding. I'm going to give this kind of short shrift, but the basic story is that to the extent people are familiar with the history of withholding at all, I think the standard story is it started in World War II, and that's sort of true. But interestingly, the 1913 income tax, something that's been largely lost to the collective memory, I think, the 1913 income tax featured withholding, and not just on wages and salaries, but on interest and dividends and royalties and so on. It turned out that it was really unpopular, and withholding was repealed in 1917 in the middle of World War I. And the government relied solely on some combination of information reporting, third-party information reporting, and taxpayer honesty to enforce the tax until World War II, when World War II brought back withholding. But the irony here, in my view, is that World War I killed withholding and World War II brought it back. Well, that's curious. How could that be? Well, ask me about it if you like, but I'm going to move on for now. There he is. I'll say something about him. This is Beardsley Rummel, who is had no real official government position, but during World War II, he was both treasurer of R.H. Macy's and chairman of the Federal Reserve Bank of New York. And he turned out to be one of the most successful non-government policy entrepreneurs in the history of the federal income tax. And he's at the middle of the story about the reintroduction of withholding in World War II. But that's all he gets today. Okay. Okay, next story. This is going to sound unusually wonky even for tax, but I think it's kind of interesting. Okay, so next story is about whether the base of the income tax should be tax exclusive or tax inclusive. So in a tax inclusive base, which is what the income tax is today, the the amount you end up paying in tax is included in the base of the tax. So if you have $100 of income, the tax rate is 40%, you pay 40% of the whole $100 and you're left with 60 and the government gets the other 40. The other type of tax base, of which the sales tax is an example, is a tax exclusive tax where the base does not include the amount that you pay as tax. If you imagine the same little story I told you just now, where out of $100 the government gets 40 and you get to keep 60, that could be expressed as a tax exclusive tax, in which case the base would be what you get to keep, which would be 60, right? And the tax would be what the government gets, and the tax rate, instead of being 40%, would be 40 over 60 equals 67%. So the difference between the two bases is really just they're equivalent if you adjust the rates accordingly. Okay. Well, the early history of this was one of the things that neither Cordell Hull nor anyone else thought about at all in 1913. And there was a provision that said that taxes are deductible in the 1913 Act, period, end of story. Didn't say anything in particular about the federal income tax and whether or not it was deductible against itself, so to speak. If it was deductible against itself, it would have been deductible with in effect, a 1-year delay, because the way the payment of taxes worked back then was you didn't pay your 1913 tax until 1914. So the question was, when you paid your 1913 income tax in 1914, could you claim a deduction against your 1914 income for the 1913 tax that you paid in 1914? Well, if you read the statute literally, it said you could, because it said you could deduct all taxes, but it was also clear that neither Cordell Hull nor anyone else had ever thought about that. Well, the vast majority of people weren't subject to the 1913 tax, and even the people who were subject to it, the vast majority paid tax at the rate of 1%. So the question about the difference between inclusive and exclusive base doesn't really make much difference if the tax rate is 1%. It becomes a lot more significant if you're in the middle of World War I and you want to impose tax rate at much higher percentages. If, for example, Congress wanted to take 60% of somebody's last $100 of income, if you wanted to express that with a tax exclusive tax, the rate would be 60%. But if you wanted to express it as a tax, excuse me, I said that wrong. If you want to express it as a tax inclusive tax, the rate would be 60%. But if you want to express it as a tax exclusive tax, the rate would be 150%, 60 that the government gets over the 40 that you get. And when Congress focused on this issue finally in 1917, because they were forced to by wartime revenue needs, it occurred to them that if they stuck with the tax exclusive base, the only way to raise enough revenue would be to have marginal tax rates of 200% and 300%, and that might be politically problematic. So they fixed it, if you want to think of that as a fix. In 1917, they said no longer is the federal income tax deductible against itself. They were kind of forced to fix that because the revenue needs couldn't have been satisfied otherwise. And Rich was talking about Chapter 11, which I'll spoil a little bit, as the question of whether or not early mistakes get corrected or not. The single most important consideration in the question of whether or not early mistakes get corrected is whether or not Congress could afford not to correct them. And this is one they couldn't afford not to correct. But two things on this. There was an interesting colloquy in 1917 between two senators on this issue. There was a Senator, Porter J. McCumber, Republican of North Dakota, who thought that denying a deduction for the income tax against itself was a tax on a tax, and that was the worst thing you could imagine. And then there was a Senator, Henry F. Hollis, Democrat of New Hampshire, who had a pretty different view, and this was the conversation between them on the floor of the Senate. So, Mr. Hollis, is it the understanding of the senator that under the law as it now exists, the taxpayer may, in order to ascertain his net income, deduct the sum that he has paid by way of income tax during the year past? McCumber, certainly. Hollis is a member of the Senate Finance Committee and was in 1913. Okay, Hollis, is that so under present law? McCumber, oh, certainly, that's the law. I read the law to the senator. It includes all taxes. Hollis, has that been the practice as the senator understands? McCumber, it has been the practice, yes. Hollis, some people have been thrifty enough to do that, the senator states. I did not know that anyone ever did it. Now, this guy drafted the 19th, well, he wasn't Cordell Hall, but was involved in the drafting of the 1913 income tax, and 4 years later had no idea that the 1913 income tax had a tax-exclusive base. Postscript of this is a 1945 New Yorker cartoon. Remember that the income tax had just become a mass tax that most people had to pay. And if you thought there was some subject that was so unfunny it would never make it as a New Yorker cartoon subject, this is a cartoon that is based on confusion about whether the base of the income tax is tax exclusive or tax inclusive. Can you read it in back? I don't know. So the woman is saying to apparently an IRS official, or possibly a bank official, but I saved up that money little by little all year just to pay my taxes with. I don't have to pay taxes on that too, do I? So it's not funny, but it's but it's funny that it's not funny, right? Okay. All right. I think I have time for two more stories if I don't dilly-dally. Okay. So Rich referred to the deduction for unrealized appreciation in property given to charity. I think of that as one of the two great free basis provisions in today's in federal income tax. So the idea of basis, as many of you I think know, basis in the income tax, it's supposed to be a measure of amounts that you or somebody economically associated with you has already paid tax on, and therefore you get basis in the property, so in effect you don't pay tax on the same income twice. So the way you get basis is supposed to be for you or someone close to you to have paid tax on that amount, and then you get that basis. But there are two provisions in the current law, both of which are more than 100 years old, which give you basis in situations where no one has paid income tax. One is the tax-free step-up in basis at death under Section 1014 of the Code, and the other is the charitable deduction for unrealized appreciation in, say, stocks or art given to a charity. These are both just conceptual mistakes, and it's interesting, I think, how they happened. So let's take the bequest one first. The 1913 income tax, this will become kind of a refrain by now, didn't address this question. So it said if you receive property by a gratuitous transfer, either by gift or bequest, and the property is worth more at the time of the transfer than the transferor's basis in it, what is the recipient's basis in the property? Statute didn't say. So in 1914, Treasury has to write a regulation, and they declared that basis equaled fair market value at the time of the gift or bequest, which meant, of course, that there was a tax-free step-up in basis in every gift or bequest of appreciated property. This was just wrong. Congress forgot to address it, and Treasury, when they addressed it, screwed up. Right? The kind of funny thing is that what was too complicated for Congress or Treasury to figure out seemed to have been not too complicated for many members of the general public. So the Wall Street Journal in the early years of the income tax had this wonderful column called Answers to Inquirers, where anyone newly subject to the income tax, which would have to be somebody pretty well off, would write into the journal with any question, and the anonymous columnist would answer. And in 1920, for example, they got a question where the correspondent writes, "It would seem that by buying stock at 90, deciding to take profits at 115, it's only necessary to give the stock to your wife with instructions to sell, and the profit will all remain in the family and no one will have to pay tax. This seems to me to so easily permit evasion of the income tax that there must be some further explanation for it somewhere." And the answer is, no, there's no further explanation. So this anonymous letter writer understood what Treasury did not. Well, finally, Treasury and Congress awakened from their slumbers. And in 1921, they fixed it at the suggestion of Treasury. Congress fixed this with respect to inter vivos gifts, and Section 1015, which provides for a carryover basis in inter vivos gifts, is still with us today. Why didn't they fix the step up in basis at death at the same time? Well, this is Thomas S. Adams. The only picture of him I could find. I don't know why he's wearing a blindingly white jacket, but there he is at age 25. Somewhat later in life, he was the principal author of the 1911 Wisconsin income tax, and by the 1920s, he had become the principal tax advisor to the Treasury Department, and it's only a slight exaggeration to say that Congress would do anything by way of tax legislation that he told them to do. So he was testifying to Congress in 1921, and a member of the Senate Finance Committee asked him, well, you're telling us we need to fix this problem about the tax-free step-up in basis for gifts. Don't we have the same problem in the case of bequests? Shouldn't we fix that too? And he said, you've heard the expression Homer nods. I mean, he was a great man in the early history of the income tax, but he sure screwed up this time. He said, no, you don't need to fix that because there's an estate tax, and as long as the estate tax taxes the appreciation, we don't need the income tax to tax it as well. That was wrong for about 3 reasons, each one of which would have been more than enough. I won't tell you why now, but read the book. But anyway, if you're wondering why we have this nonsensical tax-free step-up in basis today, it's a combination of Thomas S. Adams screwing up in 1921, and the mistake, of course, having a constituency in wealthy families who benefit from it, and the fact that it was a small enough mistake that Congress could afford not to correct it, where they could not have afforded not to correct the same or the similar mistake for gifts. So the other free basis provision is the charitable deduction for unrealized depreciation. This also is just a mistake. The history is pretty similar. The charitable deduction was enacted in 1917. It didn't specify the amount of the deduction in the case of a gift of property rather than cash. Treasury again was forced to answer what Congress had not. Treasury again got it wrong and said if it's appreciated property, the deductible amount is the fair market value, even though that in effect treats you as giving away for tax purposes, something which you've never been treated as having for tax purposes. And again, everybody except Treasury seemed to recognize it was wrong. So the Boston law firm of Ropes and Gray, you may have heard of them, in 1920 sent a telegram to the Revenue Bureau saying, as we read the regulations, it looks like you can deduct unrealized depreciation that you've never paid tax on if you give it to charity. Is that really right? Please wire back at our expense. And they wired back, yeah, that's right. So now, perhaps inspired by the Ropes and Gray telegram and some comments in the Wall Street Journal column as well, Treasury eventually figured out this was a mistake. And you know what? In 1920, they fixed it. They issued a new regulation that said, we were wrong in 1918 when we said you get a deduction for unrealized depreciation. Henceforth, your deduction is limited to basis. Problem was that 3 years later, they unfixed the mistake. And what's I think interesting about the unfixing, so in 1923, they went back to the error that they had abandoned 3 years earlier. In 1923, there was a different Treasury Secretary from 1920, that guy. Probably I was going to say that the most famous and or important Treasury Secretary in U.S. history, and then I remember there's a musical. Although if Lin-Manuel Miranda is looking for a new project, this would be more challenging. Anyway, so Andrew Mellon is Treasury Secretary, and the document in the Federal Register which went back to the mistake and allowed the deduction for unrealized depreciation was signed in 1923 by Andrew Mellon. So I thought, that's interesting because who does this benefit? Well, it benefits universities and their donors, but the other big group it benefits is art museums and their donors. And isn't it interesting that the Andrew Mellon, who in 1923 signed this regulation giving this unjustified tax benefit to art museums and their donors, about a decade later becomes, I think it's fair to say, the most important art philanthropist in American history when he donated a bunch of art which he had purchased from the Soviet government in a fire sale where they were selling off all of Catherine the Great's treasures from the Hermitage in order to raise desperately needed cash during the Depression. And then he gave that to found the National Gallery. So, did he end up benefiting from the unjustified rule that he had created a decade before? Well, it turns out, although there was actually litigation on his contribution, the contribution was he claimed he donated this art to the National Gallery in a year before the National Gallery existed, and he ended up getting away with that for reasons I won't go into now. But what I was hoping to find was that he also had claimed that the property was worth more when he donated it than he had paid for it, and he claimed a deduction for the appreciation, and darn, he didn't. But one of the pieces that was at question in the litigation was the Van Eyck Annunciation, which is, and you can take my word for this, the single best thing in the National Gallery, even today. It's kind of hidden, so you have to go look for it. This has a sort of later story. Actually, both of these free basis things have later stories. That Congress tried to fix them both and sort of succeeded for a while, but then ultimately failed. So the tax-free step-up in basis at death was repealed in favor of carryover basis in 1976, but the opposition was so powerful and insistent that 4 years later in 1980, the repeal was retroactively repealed as if it had never happened. What happened with respect to the unrealized appreciation deduction was that was never totally repealed, but as part of the great 1986 Tax Reform Act, and I believe Professor Klottfelder has written about this topic. As part of the great 1986 Tax Reform Act, they made it a preference item for purposes of the AMT, which meant any donor who was subject to the AMT could not claim a deduction for unrealized appreciation, and most of the big donors were subject to the AMT. But you know what? That ended up getting retroactively repealed as well. And the reason it got retroactively repealed is museums and their donors were incredibly effective at launching a public relations campaign focused on, mostly on Van Gogh for some reason. This is Van Gogh's portrait of Dr. Gachet, which for years had been on loan to the Met, and which the Met was expecting to get as a donation eventually. But once this AMT provision was enacted in 1986, the owner decided to put it up for auction instead, and it ended up being purchased by a Japanese business person. And people were so concerned about America's precious heritage of European art continuing its inexorable westward march across the globe, that a few years later, that attempted fix got retroactively repealed as well. And the end of this story is during the period of from 1986 to about 1990, when this AMT provision existed, there was a New Yorker cartoon. So, that's a facade of the Met with a special exhibit ad, masterpieces from the golden age of tax-deductible contributions. Okay. Let's see. We have till 1:30, but should leave some time for questions. Let me tell you really briefly about. So the other topic that if I had a little more time, I would have said something about. I will say something about, but not much, is the treatment of tax in marriage and the relative treatment of single people and married people. And what I think is most interesting about this is in an era when women generally didn't really participate in tax policy discussions very much, they did participate in this area. So the original 1913 income tax, even as it was working its way through Congress, had a provision which would have created both marriage penalties and marriage bonuses in the exemptions. And there was and it actually got enacted that way too. There was who I think must be a very interesting woman, although I haven't been able to find out very much about her, a Mrs. Helen M. Bent, who even before the law had been enacted, looked at the bills that were being considered, realized the effect that they would have on married couples and on married women in particular, and wrote basically the same letter to both the New York Times and the Washington Post. They both published it complaining about this. Turns out that she lived till 100, died in 1943. When she died, she was considered significant enough that she had a New York Times obituary. She was one of the first women law graduates of NYU Law School, and although she never practiced, she was very active in the women's suffrage movement, and she was also one of the founders of the Portia Club, which was a club for women lawyers. Skip forward about a decade or so, and in most of the 1920s, the personal exemption amount for a married couple was $3,500, whereas the equivalent amount for a single person was less than half of that, was $1,500. Well, I won't try to explain why now, although maybe it's intuitive. But in modern policy discussions of the relative treatment of married couples and single people, the most pro-marriage position that's considered respectable is that the married exemption should be twice the single exemption. There's no policy reason one can think of for why you would have a married exemption that is more than twice, and yet that was the situation for most of the 1920s. So there was a federation of, let's see, let me get the name right. The National Federation of Business and Professional Women, who in 1927 sent a 3-woman delegation to, most business and professional women were single then, as you might imagine, sent a 3-woman delegation to Washington, D.C. to testify before Congress on the unfairness of the relative levels of the married and single exemptions and how that was completely unjust to single professional women. And they were represented primarily by an attorney from East St. Louis by the name of Martha Canole. Whoops. Hang on. We'll get there. Skip that. There she is. Her testimony before the House Ways and Means Committee was a front-page story in the New York Times, was covered in the Washington Post and Wall Street Journal as well, and led a little later to a feature story in the Chicago Tribune, which is what this is, including line drawing. There's a portrait of her on the right, and a somewhat imaginative portrait of her dressed as, who else? Portia, arguing her case to Uncle Sam, the judge, up there. The first thing she said in her testimony was, "I have always been interested in how Daniel felt in the lion's den, now I know." All the papers made a point that in the history of the United States, as far as anyone could tell, this was the first time that any woman had ever testified before the Ways and Means Committee or the Senate Finance Committee on a tax issue. When the committee members initially had no questions after her prepared statement, she responded to the lack of questions. Of course, Miss Phillips, one of her colleagues, is afraid that if you do not ask any questions, you simply are dismissing us from your minds. I assure you that we will not let you do that. We will see that you are troubled right along. And after that, there were a lot of questions, although I have to tell you, in the end, they didn't get the legislation they wanted. So I left a little time for your questions. I hope you will have some. One of the things I like about these stories is that the cast of characters is really pretty fascinating. So you have sort of the obvious people like the Seligmans and Halls and T.S. Adams and Andrew Mellons. But you also have some somewhat less obvious but really fascinating characters as well, ranging all the way from Mr. Louis Jackson of Montclair, New Jersey, to Martha Canole of East St. Louis. So, hope you have some questions.
Sure. My question is about administration. I don't know if you went that way, but I go back to 1913. They were in the dark, and the questions had to do with revenue estimation and compliance. So, by 1917, they had a little experience, so they kind of had some idea, but do you have any sense of what kind of revenue they expected to get and how compliant the American taxpayers were?
That I think they had next to no idea of how much revenue they were going to get. I think they just said, let's impose the tax and see what happens. They weren't too concerned about that initially because the 1913 tax raised, I don't remember the exact number, but it was less than $50 million, and even back then that was, almost nothing. Far less than 10% of the population was subject to the tax, and most of the people who were subject to it were subject to it at 1%, at a 1% rate. So the point of the 1913 tax wasn't really revenue. It was some combination of symbolism and a wedge. Now, Hall, I think kind of to his credit, made a lot of speeches to the effect that this is a wedge. We realize that there's almost no revenue with these exemption levels and these rates, but once we get more experience with it, we can lower the exemptions, increase the rates, and it turned out he was right, obviously. But in terms of revenue effects, they were just, just trial and error at the beginning. On compliance, when they dropped withholding in 1917, they kept pretty extensive information reporting. And the Treasury Department, at least in the years immediately following that, would issue annual reports saying, we are in the process of matching, and this is all by hand, obviously, of matching every single third-party information report of income with every single 1040. And if people don't report on their 1040, something that shows up on an information return, they are going to hear from us about it. Now, I don't know if that was ever true, but it's true they said it, and maybe that had enough effect. But it's kind of, there's some pages in the book on this question that between 1917 and World War II, the only really effective enforcement tool that would work on a widespread basis, as contrasted with individual audits, was information reporting. And they really knew nothing in the sense that we would think about, knowing something. They knew nothing about how much compliance that was producing. All they knew is that it was enough. Compliance estimates and taxpayer compliance management program and intensive audits and empirical research and compliance didn't get going until well after World War II. For what it's worth, current compliance estimates indicate that for income that is not subject to withholding but is subject to information reporting, the compliance rate is in the low 90s. And I suppose it's conceivable that it would have been similar under similar conditions back in the 20s and 30s, but no one really knows that. Kate?
So this is on the problem of unrealized appreciation gifts to charity. I understand that you are you're responding to the principle that seems ironclad to you, that all gain and all income needs to be taxed at some point, and people are getting away with that in this transaction. But why can't you see this additional benefit of making a gift as the charitable deduction is already a tax break designed to accomplish certain public policy objectives, and why can't you see the treatment of unrealized appreciation as just sort of an additional incentive for making gifts? And I guess the question is, was any of that debated, since yours is this historical work, was it any of it debated on those terms, or are you confirmed in your sense that this is a mistake because no one was thinking about that?
Yeah, well, there is I think we've had more or less this conversation before. I don't think I convinced you then either, but there are things about in the design of an income tax that are just logical. If you're going to have an income tax that makes sense, this is how you do it, and then you can sort of start from that and put subsidies on top of it. But just from a sort of an internal structural perspective, Basically, what the deduction for unrealized depreciation is doing is saying, we are treating you as giving away for tax purposes something which we have never treated you as having for tax purposes. Now, if Congress wanted to subsidize, if Congress thought it was really important that people give art to museums, they could replace the deduction with a credit that would be more generous than a deduction. They could even say, in all cases, your deduction is 150% of the actual value of the property. But to just single out, because this isn't a subsidy for all donations of art, it wasn't a subsidy for the donation of the Van Eyck Annunciation because he didn't claim a deduction for more than the amount he paid for it. It's only a subsidy for unrealized depreciation, and why you would design a subsidy on purpose that way, to say we are going to be more generous if you give to charity art that has, or stock for that matter, that has appreciated than if you give them, art or stock that hasn't appreciated. It's hard to see, and why you would think that was good policy. And in fact, the museums, when they successfully lobbied against the AMT provision, I think it's fair to say didn't make very technical arguments. They just said, look, Dr. Gachet ended up in Japan, give us back our subsidy. Kim?
Yeah, so I'm interested in the gender dynamics with the marriage deduction, and just wanted to invite you to maybe talk about that a little bit more. I mean, were single men anywhere in this debate? I mean, or was the assumption just that, they'll eventually get married, so, and whereas, women who work, of course, wouldn't.
Yeah, that's a really interesting question. Thank you for asking that. The people who were saying singles are getting a raw deal were all women, right? And I think the reason for that must be what you just said. That if you were a professional woman, you probably were single. I mean, I think to a large extent you kind of had to, make that decision. Either I'm going to be a lawyer or I'm going to be married, but the chances of being both are not too good, right? Whereas men weren't put to that choice, and I assume for that reason tended not to make this argument. Although since you gave me an opening, let me go back. This is, everybody read this, and then I'll read it if you can't quite read it in back, and then I'm going to ask, in the case of a husband and wife living together, your average married couple, what is the amount of exemption that they're allowed? There shall be deducted from the amount of the net income of each of said persons ascertained, blah, 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 the sum of $3,000 plus $1,000 additional if the person making the return be a married man with a wife, or plus a sum of $1,000 additional if the person making the return be a married woman with a husband. But in no event shall this additional exemption of $1,000 be deducted by both a husband and a wife, provided that only one deduction of $4,000 shall be made from the aggregate income of both husband and wife when living together. So does married couple get a combined exemption of $4,000 or $7,000? Not a policy question, just a statutory interpretation question. How many people think they get 4,000 together? How many think they get 7,000? Yeah, I don't know. But what I like about this, and perhaps this is not a terrible note to end on, is there's a particular kind of bad statutory drafting, which I'm sure you find every place, but is particularly common perhaps in the Internal Revenue Code, where you have a flatly ambiguous statute, which isn't ambiguous because they decided to have a standard rather than a rule. It's just ambiguous because they incompetently drafted it. They were trying to say either married couple gets 4,000 between them or they were getting 7,000, but there's no way of telling from this what they got. So this is at least tied for being the oldest example of this kind of bad drafting in the code. I can tell you how it was interpreted by Treasury, and I think reasonably so, as saying a married couple gets 4,000. And you notice what that means is you had both marriage penalties and bonuses from the very beginning. If you had a single person with 4,000 of income who would have had $1,000 subject to tax, single who married someone with no income of her own, the exemption goes up to $4,000 and there's a marriage bonus. If you had two people single, each of whom has income of $3,000, they have no income subject to tax. Single, they get married, they now have $2,000 of income subject to tax, marriage penalty. It's usually thought that marriage penalties and bonuses didn't exist until well after World War II, but this was one at the very beginning. And people, including Helen Bent in particular, noticed and complained, but didn't do much good. Yeah, George.
Do you know that in the last couple of years, the French Constitutional Court ruled a marginal rate of 75% as confiscation, and was struck down. In my own lifetime, during the end of World War II, it was either 80 or 90% the marginal rate was, and in the UK it was somewhere between 90 and 95% of the marginal rate. So.
Well, for the entire Eisenhower presidency, and I believe he was a Republican, the top marginal tax rate was 91%. Yeah. So there you go. Times have changed. What can I say? Well, thank you.